everybody running our system right now, pretty much for their lifetimes, has lived in a disinflationary environment, right? So that's all they know, pretty much, right? So again, I'm going to use the musculature analogy, but the muscles they've developed is, okay, how to deal with disinflation. To your point, we're now moving into a inflationary regime, needs a totally different set of rules. And so, you can make a good argument that the people we have running the system right now are uniquely the wrong people to be running it, right? Because, it's like a wide receiver versus a defensive lineman, right? They just have different musculatures. And it's like we're all of a sudden asking the defensive lineman to, be the wide receiver and be the guy who wins the sprint. It's just not going to happen, right?
Right. Well, and if you think about, what do you really need to rein in inflation? What you really need is positive real interest rates. You probably, let's just say, core CPI is going to come down to, or core PCE is going to come down, let's say 4%. Let's be generous by the end of the year. That means you need a 5% Fed funds rate. Bill Dudley has said this. You need a Fed funds rate that's positive in real terms to really address the inflation problem. We're not going to get a 5% Fed funds rate by the end of the year. But at the same token, MMT, modern monetary theory has said you can go ahead and print money. When you get inflation, the way you deal with that is not through monetary policy. You need to raise taxes, right? And so you need fiscal policy to also work to rein in inflation. But imagine, trying to get politicians to raise taxes right now in the midst of this inflationary regime. There's not anybody in Congress right now who's even willing to go anywhere near this issue, because people are already suffering from rising prices so significantly, right? And so the idea of raising taxes is just anathema to politicians. And so, what you probably need is monetary and fiscal policy to work together to address the problem right now, and it's just not going to happen. So, to your point, yes, the people that we have, and Jay Powell's a great example too. You come back to monetary policy. He said a couple of years ago, low inflation is the greatest challenge of our time, right? I mean, they have this idea that deflation is the real monster, and you have the economists tell you that inflation is dead, and and Bloomberg Business Week tell you the same thing, and so there was this mindset driven by 40 years of disinflation that deflation is really the real boogeyman, and that's so shifting those mindsets to really understand what the problem is today is going to take a lot of time, and it's that's why I think we're in another 1970s type of situation right now. We could see inflation cyclically peak here, this in July. Gas prices come down, commodity prices come down. But a cyclical peak doesn't mean that it's that this inflation problem isn't done on a longer term time frame. And so I think that's what people are really betting on right now. So we'll see a cyclical peak, and inflation will come back to the Fed's target, and it'll be done. That's where the market mispricing is off. I think that yes, we could see a cyclical peak, but the problem's not going away. And just like we saw in the 70s, we could have a larger trend of higher peaks, higher highs and higher lows in inflation over a period of years. That's something markets aren't even considering right now.
Right. And it seems like from what you're saying, you think that is more probable at this point in time.
Absolutely. I mean, it's insane that, the Taylor rule says Fed funds should be 10% today, right? And so the Fed is laughably behind the curve. The idea that, Jay Powell would say they've now reached the neutral level with, this 2.25% to 2.5% range in Fed funds when CPI is 9. It would be laughable if it wasn't so painful to consumers right now. I think it's, I've said, Stan Druckenmiller used to go to his investment team and say, you just came down from Mars. Here's what the economic data is. Here's all this stuff. Where do you think Fed funds is? Nominal GDP is running 7-8%, right? Inflation's 9, so you're getting negative real GDP of 1. Retail sales, nominal retail sales are up, 7-8%, all these things. You just came down from Mars. Where do you think Fed funds rate is? And I mean, anybody in their right mind would say Fed funds has got to be 7, 8, 9%, right? At least
Right.
the inflation rate. Now I tell you, you just came from Mars, Fed funds rate is 2.5%. What do you do with your investments? I think that's how people should need to be thinking about this, you know, and because the answer is simple. Say, I don't want to own financial assets of any kind. I'm not going to buy it. You know, interest rates might come down in the short run, but I don't want to buy a 10-year, you know, treasury yielding 2.5. I don't want to own stocks at the highest valuations in literally today, even after the correction. You know, the most valuable valuation metrics are still above every previous peak we've ever seen in stock market history. I don't want to own equities at that, you know, kind of overvalue. I need to own things that are going to, real assets that are going to protect me from this, probably the biggest mistake in Fed history.
If you enjoyed this video clip, click here to watch another one you should like.